Hello everybody, welcome to the channel. My name is Bernie and I want to talk to you guys about my retirement account. I've been buying Treasury ETFs, the Treasury ETFs TLT and EDV, and they haven't been doing so great lately. Matter of fact, I'm down pretty good here, 10,500. But on the plus side, my dividend income has been doing pretty good. I'm up to almost 7,000, 6,970 a year. And these are the distributions here. So I'm going to continue to buy in the treasuries. Actually, my plan is to get this account up to 10,000 a year. I did the math earlier and it's going to be a little bit over 200,000, maybe like 205 by the time I hit 10,000 a year. So once I get it to that point, then I'll be buying into something else, but I'll still hold on to this and reinvest the dividends into this. And this is the performance of the Treasury TLT, and it's at its all-time low. I think right now it might be at its all-time low. I think it was at 83 about 20 years ago. 83, somewhere around here, it's the all-time low. EDV is definitely at its all-time low because it's a relatively newer ETF compared to TLT. This is the distributions, and back in 2021 it kind of lost a decent, I think it's about 50% from its average, or from the height of its average, and it lost 50%. And recent, or the last years, has been going up. And you can also compare that to EDV, which its distributions have been climbing steadily, and it did come down here in 2021. It also lost some distributions here, amounts, but it's been climbing since. And I imagine it had to do with the changing interest rates. So the change in the interest rates for the federal funds, this is probably what did the shift for the distributions. There's also the case of debt repayment. At one point, will require cash for credit payment, for the payment of debt. And this is our monetary base, which it means that this is our cash in the system, in circulation. And it's been pretty stagnant, 5.5 trillion of cash in circulation, compared to 23 trillion and climbing worth of same as cash. And this is anything from checkings, savings, anything that you can liquidate and use as cash is here. Money market accounts. So it's a completely different measure, and you can see how different it is from what the actual cash is to same as cash. There is a big difference here. Any kind of bank deposit in here. So this is used to pay the debts. As the world continues to drop the treasuries and sell them off, the Fed has to step in as the buyer of last resort and buy some of those treasuries from the market to keep it liquid. Since December 3rd, the Fed has been buying, which means that they believe the market is weak. But they've also been slowly lowering the interest rates, trying to stabilize the market, if you will. And I mean, there's a big focus on the $40 trillion worth of national debt. And 40 trillion is a lot of money, but it is not the big picture. This just involves government spending. Does not involve the dollar system in general. And this is the usdebtclock.org. I think it's a nice little tool if anybody's interested in looking it up. Um, but I am more interested in the derivatives, the dollar derivatives, which means that it involves any dollar debt that exists in the system. So compared to the 40 trillion US debt, the total dollar debt is much, much higher, uh, coming in at 941 trillion. In comparison, the amount of same as cash, which going back here to our M2 money supply, um, same as cash is equal to 23 trillion, which equals to a little bit under 2.5% of the total dollar debt. So if there's only 2.5% of money that can be used at any given point in time to settle any amount of a sell off from $941 trillion, um, I think to me, it's justifiable building up a nice chunk on my retirement account with them. And just to verify that the it's just like another a quick search I did here that the derivatives are debt related. So they are debt related instruments, and they will have to be satisfied at any given point in time. And there's also a theory out there from Brent Johnson. It's called the dollar milkshake theory, that states that we can read this right here. It's a financial concept created by investor Brent Johnson. It states that during a global financial crisis, the US dollar will get much stronger instead of collapsing. That's basically the basis of what I'm trying to do here. Just get into something that nobody wants, and have the dividends kind of hold me in the meantime. Um, and of course, this is not going to be my only position, but I do want to grow it more so I can get these dividends up higher. And we'll see what happens. Stay tuned for the results. Hopefully, it won't take me a whole another year to put a video out, but this is what's going on with my account. Cheers, everybody. Hope everybody's well. Have a good day.